Hello, everybody. Welcome to day 3 of the bootcamp, right? So I'm going to keep it nice and simple, right? Short and sweet. Today's agenda: what is an institutional swing high, swing point? Sorry about that. Let me just say low. Okay, fine. What is an institutional swing high or low? Patience for the third swing points or point. Mistakes that you will make while looking at this. And then finally, I'm going to show you guys how to blend order block theory with the institutional swing points conceptually. Okay, keyword being conceptually. The work that goes behind this comes in the form of uh, homework, which you should be doing. Okay. All right. Let me hook up my whiteboard. So give me a second. Give me a second. So anyways, looks like I need to update again. I don't know why. Okay, so this teaching, right? It's going to be very important. This is where you'll be able to connect all the dots. When the actual move will, actually happen, because there are two actual moves or two real moves within an institutional swing point. Okay, or within an institutional swing high or low, right? Keep in mind everything I say, no matter how minute it is very important. All right. So I think I can share my screen now. So give me a second. Okay. All right, I think it's fine now. Bring it here. Resume. Okay, perfect. Perfect. All right. Now, here's what we're gonna do. Okay. Given that today's agenda is essentially institutional swing points, okay, we need to first define what an institutional swing point is. All right, what an institutional swing point is. Now that's the question that you should be asking yourself. What is an institutional swing point? How am I going to find it? Right, it's as simple as this. An institutional swing point, okay, institutional swing point, institutional swing point, right, looks like this. So you have a swing high, we have 1, 2, 3. Okay, this is how the bar should look like. Then you have an institutional swing low, swing low. All right, so that is what? 1, 2, 3, right? So you need to have this pattern here, right? This is the pattern for it to actually create a price range. Listen carefully. This is the pattern for it to actually create a price range, right? This is the pattern for it to actually create a price range. So now, how can we define it in terms of words or in terms of letters, right? That's easy to understand, right? Here's how it is. Get an institutional swing high. So it's called an institutional swing high, right? We know that it is 1, 2, 3. So how is that defined as? We have a high followed by a higher high, then followed by a what? Lower high. Okay, followed by a lower high. Then you have an institutional swing low. What do you have? You have 1, 2, pardon me, you have 1, 2, 3, right? So that means what? Low, 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 and then you have a what? Higher low. Okay. An institutional swing high has a high, higher high, and then a lower high. An institutional swing low has a low, 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 and a higher low, right? So that is the very basics behind an institutional swing high or low. Okay. Now here's a question. Why is it called an institutional swing high? Why is it called an institutional swing low? It is because when we look at it from an institutional perspective, right? When we look at it from an institutional perspective, we understand that from an institutional perspective, price moves based on liquidity, right? We need to absorb liquidity from one spot to move to another spot and absorb liquidity from there, right? That's the basics. So given that it's called an institutional swing high, for example, right? So we have one, we have two, and then we have what? We have three. Now here's what happens. Over here, you have a stop hunt. Okay, you have a stop hunt. Over here, price jabs into, so price reaches a what? An HTF, higher time frame PDRA. Okay, price reaches an higher time frame PDRA. And so what's the higher time frame PDRA? You have mitigation block, breaker block, you have liquidity void, fair value gap, you have order block, rejection block, and then hold high or low, right? Hold high or low. So what does the institutions do? What does smart money do? Smart money tackles stops from here in order to reach a high time frame PDRA. Now the question is, why do they do that? Why do they need to take out liquidity in order to move price? Because above highs, again, now listen carefully. This is not working good. Above highs, what do you have? Above highs, you have what? Buy side liquidity. Okay, buy side liquidity. Then inside PDRAs, what do you have? You have what? Orders, resting orders, right? Resting limit orders. So what's going to happen? Smart money is going to use buy side, all right, and pair them up with the limit orders here. So these limit orders get triggered, and then because of the size, right, because of the size behind these limit orders, you're going to see what? You're going to see in big letters, you're going to see displacement. Okay, that's when you know a price swing. Okay, that's when you know a price swing is what? Institutionally sponsored. Okay, that's when you know a price swing and it is institutionally sponsored. So that's what goes behind step here between step 1 and step 2. So now obviously you can reasonably infer from what I'm saying, right? You can reasonably infer from what I'm saying that the first high formed in a swing high, okay? The first high formed in a swing high at 1 is what? Engineered liquidity for smart money to absorb. All right. Number 2, what's that? What is smart money doing over there? They are absorbing engineered liquidity to pair orders inside of a premium PDRA, because in this case we're looking at swing high, right? So swing high reacts from a bearish PDRA, so of a premium PDRA. Okay, engineered liquidity absorbing 1 to pair orders inside of a premium PDRA. So those, and of course over here you have your what? Displacement. Okay, the initial move here is a displacement. So this initial move, right, is your range creation. Okay, listen carefully. This initial move over here, number 3, this big displacement down here, that is known as a range creation. You are creating a new range. Okay, listen carefully. You are creating a new range. All right. Now, as you create a new range, okay, as you create a new range, obviously, due to the nature of a displacement, it's going to leave a what? It's going to leave a liquidity void, right? It's going to leave a liquidity void, and price needs to come back and rebalance this imbalance. That is the liquidity void. Okay, that is the liquidity void. Right? So that is why price comes back up. Okay, that is why price comes back up. Okay, and of course, then you will use your PDRAs, the break mitigation block, whatever, for your entry. Okay, for your entry. All right. Now, what about the last part? The move, the final move down, right? This is where you want to be entering more majority of your positions. All right, this is the most safest entry. All right. After the initial displacement, when price retraces back up, right, this over here, right, that is your most safest entry. this here, safest entry. Why is it a safe entry? Because number one, you got number one, which is your stop hunt. Number two, you got your PDRA. Number three, you got your displacement. What does the displacement say? It is what? Institutionally sponsored. So institutionally sponsored, right? Then this fourth portion over here is your low risk entry. Why is it low risk? Because you have your displacement, your stop hunt, and your PDRA, or your stop hunt, PDRA, and displacement, right? Those are the three factors which makes a successful trade technical in terms of structure. Okay, in terms of structure, which is why if you look at this right now, if you just look at this crude depiction of a diagram over here, right? So you have 1, 2, 3 up, and then you see price boom going down, right? So what do you have? Stop hunt. Let's say this goes into a bearish PDRA, so minus all the bearish all block. Here's your engineered liquidity, right? Here's your fair value gap here, so minus FEG, and you enter over here and price goes down, right? It's almost a guarantee on any time frame that when the narrative is right, when the narrative or context is right, or to put it in simpler terms, if your storyline is right, these entries are more or less guaranteed. Is that how you spell guaranteed? Someone correct me later. Okay, it's more or less guaranteed, right? It's more or less guaranteed. So this is the anatomy of an institutional swing point, right? Stop hunt, PDRA, displacement, return back into the range, initial range, which is this here, okay, which is that here. Now to get to the final part of an institutional swing point, right? Before I get to the final part, take all that you learned right now, okay? Right now what I just showed you, right? And on your charts, draw the bullish example, which is a swing low, right? And figure it out, okay? So now, go down. Where is price most likely to come into? So I'll use the same example, right? So you have the stop hunt, PDRA down, right? And price is going to come up, right? So price is going to come up. So if price is going to come up, where will it come up to? It will come up in between this high, okay, or between this high and this low. That is your trading range, okay, or that is your consolidation. Because why? Now by now you should understand that this is your what? Consolidation, expansion, reversal. What is next? Next is the retracement reversal, right? Next is the retracement reversal. So I leave that for you to find out, but that's not the point over here. Now the point is this being the consolidation, right? The price is going to return back into. So sorry again, okay. This being the consolidation, the price is going to return back into, right? You want to split this into half. So split it into half with the blue. The most ideal scenario, right, would be for price to come up here into the 50% mark and then drop. Oops. Then drop. Okay. Now there can be anything over here. Okay. There literally can be anything over there. So if I use a pen again, so blue pen, yeah, anything over here. So this being your discount, this being your premium of this range, you can have literally what? You can have a small mitigation block. Okay, you can have a small mitigation block, You can have a breaker within a breaker, right? So you can have a breaker inside of a breaker, or inside of this range, you can have a liquidity void to be filled up, all right? Liquidity void to be filled up, or you can have a value gap to react from, or an order block to react from, right? And again, you can rejection block would be what? Most extreme point. Okay, the rejection block would be the most extreme point. And finally, if this is to not work out, price will straight up head for the old high. All right, price will straight up head for the old high. Okay, that's all. So that is it. So I want you guys to apply to the bullish scenario as well, which would be this. Which would be one stop hunt up, down, higher. Okay, higher, right? So that's all. Now, when thinking about, waiting for all of this, right? Majority of your losses, okay, here goes. Majority of your losses is going to come from this. So you have this over here. Fine, all good. Now, when you see price doing that, right? When you see price doing that, and as you see price coming down, right? You see this displacement starting to occur, right? And you keep on selling, right? You sell over here only for price to not even break structure, but for price to just, take you out, right? For price to just take you out, because nothing is confirmed until this low is taken out. Okay, now of course there are advanced concepts, but since this is the boot camp, nothing is confirmed until this low is taken out, right? Nothing is confirmed until this low is taken out. So avoid this. Okay, you need to have patience for your third swing. Your third swing being this one here. And that is your third swing. You need to be patient for this third swing. Once price returns back into this range, this is when you start thinking about executing a high probability trade. So why is that? Because as price is displacing lower, you know that, okay, if it's displacing high, okay, fine, this has some value, right? This PD array over here that it reacted from has some value. This top hunt was nice and valid, right? So all it's doing is coming to recapitalize on anything over here just to go lower, right? Just to go lower. Okay, that's all. So that would be it regarding this. So now let's talk about blending or block theory from what we learned in Bootcamp Day 2 with the institutional swing points. Okay, with the institutional swing points. Right. Again, it's very simple. Right, it's very simple. This bootcamp, the new one, it's aimed at being super simple, right? While you guys have this new Streamlined Bootcamp, you can refer to the old videos as well, right? Or maybe you can refer to the old videos first and then come back to this one, which will basically put everything together. All right. So blending order block theory, right? So we understand that an order block means a high probability order block is one. Now for this, I'll use a bullish example. A high probability order block would be what? We have this. Okay. So we have this green candle. We have this black candle. Okay. So this is your order block scenario. Okay, that's a bullish order block. Now, if this order block is bullish, right? Now, what do we need to look for? From an institutional swing point perspective, what do we need to look for? We need to look for a bullish swing. So a bullish swing is given by what? So it's bullish swing is how? Low, lower low, higher low. Okay, this is your bullish swing. Boom, boom, boom. All right. So with this being your bullish swing, okay, here's how it's going to be. You have your this one, and price goes boom, goes up, right? It goes up. Now here's the thing. This up move here is synonymous to this green candle. This down move here is synonymous to, this down move over here is synonymous with this one. So here, you see this signature in price, right? Okay, you see the signature in price. What is, right? What is your, trading rate, or the original consolidation that you're going to use? This one, right? So from a line chart perspective, if it is this one, then from a bar chart perspective, it is what? This one, right? The down close candle itself. So what are you going to do? You're going to split it into half. You're going to wait for price to come back into it, and there's your buy. Stops are here. Okay, there's your buy. Stops are here. Right? It's as simple as that. Now, yes, it's not as clear cut in real life, right? In comparison to the way I'm explaining it and showing it, right? This boot camp, right? Now get ready for the small twist, right? If there's a trade-off somewhere, okay? This boot camp this time around is not aimed at holding your hand. You get the concept, you apply the concept, right? You get the concept, you apply the concept, you find the different various scenarios, because price is not going to do this and come back down immediately. No, that's a perfect scenario, but it 60 to 70% of the time, this shit does not happen. Okay. Instead, what you will see on the chart, all right, what you will see on the chart most of the time is this, right? So you get boom, boom, so many lows, and then you get this move, right? And then after you get this move also, you get smaller moves, right? Here, and then you get this displacement. But now you have to understand that what is the low prior to the lower low? This one. Of course, this is the lower low. What is the breaking point prior to the lower low? This point here, right? So on the higher time frame, or from a bar chart perspective, this is number one, this is number two, this one here, this is number one, and this entire thing is number two, right? From a bar chart perspective, it's going to look like this. We're going to have down move here. We're going to have several other moves inside here. All right, and then you have price doing this, bigger one, move down, going up, right? And this is going to be your down close. This is going to be your bullish candle. Stuff like this, stuff like this, stuff like this, right? So this is where you need to learn how to be flexible, right? This is where you need to learn how to be flexible. And this concludes today's lesson. You got the basics, you got the foundation. Now it's up to you to apply it on the chart. All right. So homework. Let me check out what the homework is for you. I don't have it written down. It's on the website. All right. Your homework is right. Here's the homework, right? So homework, blend order block theory with institutional swing points inside of 50 examples. Now here's the catch, right? 50 back-tested examples, 50 front-tested examples. Okay, 50 back-tested examples, 50 front-tested examples, documented inside a PDF. This is your homework. This is a very hard piece of homework because of this portion, right? You're not to forget this. You are to do this if you want to get better at pattern recognition, right? So that's all for today. I'll see you guys in the next one. I see you guys this Sunday anyway. So yeah, with that, I'm done. See you soon. Bye-bye.